Hello, wonderful people. I'm back with another lecture, and this one was a complete beast, around 4 hours and 30 minutes long. But as you know, here on this channel, we keep things concise, so no worries, this will be concise. If you're new, don't forget to hit the like button, subscribe, and check the description for PDF notes if you want them. ICT has been coming live almost every day now, so the price action we observe is always a continuation of past moves. If you've been following my summaries, you're in a good spot. But for those who are new, I highly recommend watching Lecture 13 after this video to catch up. This yellow area here represents a volume imbalance from the daily chart. It's significant. Below this volume imbalance, we can see the upper band of a sell-side imbalance and buy-side inefficiency. Additionally, this is the new day opening gap ROM, August 20th. One more crucial point before moving forward. Always click on the settlement feature on TradingView. Doing so will give us a larger range for our imbalances, which expands the volume imbalance. We'll always go for the larger volume imbalance or any other inefficiency. ICT highlighted an essential point today. Knowing where price is headed is one thing, but understanding where to get in within that price leg, where we can achieve the best trades with minimal drawdown, is a completely different skill. It's all about mastering entry and exit points within a price leg. And that's where many traders struggle. Even when you've secured some profits, there's always that risk of making decisions outside of your plan, whether it's from overconfidence or fear of missing out. This is why taking partials is a safer approach, as it allows you to reduce the emotional pressure, locking in gains while still having the opportunity for further upside if the market continues in your favor. We have a rejection block here, followed by the consequent encroachment of this wick, with buy-side liquidity resting above. If there's no further bad news coming from the Middle East, ICT anticipates that price will trade into this fair value gap. As price moves into this fair value gap, it will provide us with key signatures, signaling whether it intends to push higher and clear the levels above. We've seen that price has been bullish, delivering in one direction without any significant down close, except for this one. It's important that this down close respects the price action. If price falls below this down close candle, then we will anticipate bearish prices. We have the consequent encroachment of the wick here, along with the opening range gap in the shaded area. Once this gap forms, even if we're expecting higher prices, we should anticipate whether price is willing to reach the CE of this gap. The opening range is dynamic. It consists of the price action within the first 30 minutes, where we note the high and low, and then we can extend this range throughout the entire session. You'll often notice that price respects this level. The first fair value gap within the opening range gap is extremely powerful. This fair value gap can be used repeatedly in both directions, and you can spot it on the 1-minute or sub-1-minute chart. ICT emphasized that everyone should watch for this in their charts and log data to observe its behavior. He advised tapering and backtesting this data point. ICT mentioned that whenever there's a gap up like this, apply the Fibonacci tool, mark the CE, and there's 70% chance that price will return to the CE of the gap. However, this doesn't mean you'll have a 70% strike rate. There's a difference. You might get stopped out initially, and then the price might fill the gap. There are always nuances, but ICT said this is a powerful concept to have on your charts. He encourages everyone to monitor this and recognize that over 5 trading days in a week, this could become your bread and butter model. This concept applies to both gap up and gap down scenarios. When we're bullish and price gaps up but doesn't return to the CE of the gap, what does that indicate? It shows a strong bullish signature. Typically, price touches the CE or even goes beyond it to the last quadrant. But in a strong bullish market, we want price to leave a small portion of the gap untouched. After reaching the 50% of the gap, we need to ask if price is giving any signatures indicating that it's ready to move higher. Where should price be allowed to travel according to our price action and order flow? The opening range high, followed by the consequent encroachment of this wick from rejection block, should now be our points of interest. Once the first 30 minutes of trading are completed, we define our opening range. At this point, we can overlay the quadrant tool and combined with other confluences, Use this as a reference point for entries, something ICT hasn't shared before. The remaining portion of inefficiency here lacks sell-side delivery. What kind of price action should we anticipate as price moves toward this area? ICT would expect price to quickly drop below, filling the remaining inefficiency. We also have the new day opening gap within the lower portion of the gap, and price reached this level rather suddenly. Price delivered into the new day opening gap. Notice this area. This is where we have the consequent encroachment of rejection block. And if you want to learn more about rejection blocks, ICT said it's covered in the core content. I've reviewed the core content, and I believe it's in month 4. When price gaps up, passes through the rejection block, but fails to reach the consequent encroachment of the wick, this alone gives us insight into whether the order flow is bullish or bearish. In this case, we had a gap. Price rallied up, then fell back, with all the candles closing below the rejection block and failing to reach the CE of the wick. This suggests that the order flow is turning bearish. We use order flow to gauge bullish or bearish conditions. When price pulls back, returns to the rejection block, and barely pushes above it before rejecting, that forms what ICT refers to as turtle soup. Price then takes out the swing low, which could serve as one of your models. It's all about understanding this information, forming a model from it, and backtesting it. This right here is the first fair value gap. Price extends upward and runs into the rejection block. Notice that the opening range low hasn't completely closed the gap yet. If price moves above the gap high and closes near the upper side of the gap, or within the gap, then price is giving signals that it is ready to deliver to the sell side. Once price reaches this sell side, we can expect a full gap closure. For beginners who has taken a short position, it's advisable to take partial profits just above the full gap closure. When this sell side liquidity is taken, we want price to close that gap swiftly. At this point, ICT applies the quadrant tool over the opening gap and asks us to observe the price action. We see the fair value gap within the third quadrant from the bottom, and we also have the new day opening gap. Price moved into the fair value gap, fell, and swept all the sell-side liquidity, especially targeting relative equal lows. Some new traders see the fair value gap and jump in prematurely, often getting punished. It's essential to have another PD array or some narrative to confirm your side. When you have these aligned, price moves to your target more quickly, and you face almost no heat in the drawdowns. If we're bearish, by this stage, we should be done, because we've already had 3 legs of liquidity seeking downside. This sets up a potential retracement of the range. Whenever we see 3 to 4 legs in one direction, it's wise to be cautious about taking trades at the bottom of the range. The gaps which delivered the price to target the opposite side of liquidity very swiftly, ICT mentioned that the gaps will likely to remain some form of inefficiency within them. If you've taken this trade from an inversion, especially in this case, your stop loss could be quite small. You can place it just above the inversion fair value gap, and there's a reason for this. We have a bullish candle, followed by the next candle, immediately rebalancing that move. This is the price signature telling us price wants to drop quickly. We could have taken another entry here, and there's a lot to unpack, so it's worth watching 2 or 3 times to catch all the details. This line marks the consequent encroachment of the daily volume imbalance, which price hits. This is also an inversion fair value gap, something ICT has taught earlier, formed within the range where a breaker block was followed. Price moved down, took out the lows, and then went back to this FVG. As price was dropping, ICT expected it to come up and touch the new day opening gap low while taking out the swing low. However, price didn't quite reach the new day opening gap, but instead respected the CE of the volume imbalance. Notice how price respects the low of the volume imbalance. Additionally, this fair value gap is connected to the rejection block, aligning with the old low of the volume imbalance. This candle is rejection block, and price just went on and dropped further.